Howdy everyone, Greg Martin, the Entrepreneur's Banker here. And on this episode of Selling Your Business 360, a full circle view of your exit, we talk with Randy McDougal. Randy is a lifelong entrepreneur and he's been part of some pretty big companies, strategic buyers. And so from that perspective, Randy knows what it's like to be on the buy side of a strategic buyer, someone that is going to acquire your company to either maybe expand into a geographic area, to maybe bolt on to your operations to theirs and find some synergies. But it's a little bit different than a financial buyer. So I hope that you enjoy this episode and you learn as much as I did from Randy as we learned about what it's really like to kind of peek behind the curtain and see what a strategic buyer thinks. Well, welcome back, everyone. Greg Martin, the Entrepreneur's Banker here, and I'm so excited to have you and to have this conversation today with a great friend of mine, Randy McDougal, Fighting Texas A class of 1985.
Yes, sir.
And Randy and I have known each other for probably 2 or 3 years, and some of the things that most impress me about Randy is that he is just so genuine and he's so passionate about serving and pushing entrepreneurs towards success. So Randy has got a wealth of experience specifically talking about selling and buying businesses, and it's the buy side that we're really going to focus on today. And Randy, you've had a lot of experience in what I'm calling a strategic buyer, or a buyer that comes along and looks at a business that an entrepreneur has and says, okay, well, I can fold that into my existing operations, or I can maybe expand geographically, or maybe just kind of bolt it on and have it run independently. But to have a more strategic focus and get synergies and stuff like that. So first off, thank you so much for joining us today. And just tell us a little bit about yourself, and you've got some really cool stories about what you've done, but really specifically about companies that you've helped in the acquire process.
You bet. Well, thanks. I appreciate being here. And, it's exciting, the whole process of thinking about being either on the buyer side or the seller side, and having worked with both and just thinking about that buyer side, have definitely, I'll say up front, have looked a lot more than actually executed. Yeah. And that is part of it, is being comfortable with that. And my experiences have included buying in a very small level, something that would just be a little bit of an add-on to the business, to something where it would really be a complete expansion and add a new set of service products, even a new line of business to that, and so working with that.
Yeah. So as you're going through that process, and I also want to say that one of the unique things that Randy brings to the table is that now, since you've kind of moved on to a different part of your career, you're a certified EOS implementer.
All right.
So EOS, for a lot of you, that I'm sure that you know it, but if you don't know, it's the EOS is Entrepreneur's Operating System, a operating system of businesses that was codified by Gino Wickman in his book Traction. So we'll kind of touch a little bit on that, but having a system and having a good running organization, we've consistently heard from a lot of the entrepreneurs we talk to that have sold or bought, that is super critical, because a lot of entrepreneurs grow their baby. And they start their company 20, 30 years ago, and they grow it, and it is them. And that really doesn't have a whole lot of value to a strategic buyer, because you're going to go away as the owner. So having EOS, having some type of that system in there, really does help. So let's talk about your buying experience, and how did you find or identify potential companies to look at, and look at a lot more than actually acquire?
Just thinking about it, the examples that run through my mind are primarily relationships. That is the real, yes, you can go out, you can find a broker, and they can search out and find that. And there are certainly examples, and have seen success with that. And at the same time, seem like the most powerful, and the ones that I'm trying to remember, I think the ones that are actually consummated were there was a relationship going on. It wasn't necessarily me or someone else having the direct relationship, but way I like to say it is good people connecting good people together, and you start going down that path of communicating. So it sounds just trite and said over and over, but at the end of the day, that's what it comes down to is being able to have those different connections, have those conversations, because there has to be a level of trust from the very start in that.
Okay. So, and that kind of makes sense. So being part of trade organizations or something within your industry is probably a good idea to find those. I mean, strategic partners typically are bigger. Sometimes they use debt financing, but not those are much more sophisticated. But a lot of times they just stroke a check, or they're private equity backed or venture capital backed, and so they're able to do that. So being involved in your industry is a potential source of partners when you're looking to exit. So let's talk about from the buyer's perspective. What's the due diligence process? I mean, can you kind of break that down? I mean, I know it's depending on a 6-month process, or shoot, I've heard as long as 18 months. But what's the process, and then what are you looking for as a buyer in that process?
It can be. I've even actually seen it longer than that, because the deal would kind of okay and whoops, not work, and okay and not work. And
I've heard a lot that every deal has to die at least once.
Yeah.
If it doesn't die once, then it's not going well.
Yeah, actually, that'd be an interesting study. But I would think that absolutely is true, and sometimes multiple times. So I think there is a component of being comfortable that the deal might die, because once either party gets to the point that the deal can't die, now you got something very unhealthy going on, and it starts to skew the mind, the thinking in that. So that's a huge part of it. But you mentioned process, and since obviously I love process and system, that is a big part of it. The first time I really saw this in play was when I saw the due diligence list, and it's a very simple concept, but having that checklist. And I think a lot of people don't quite know where to go. The good news is with Google, you can find due diligence lists, and those are critical because it gives your team a foundation. Now you want to make sure you configure it for yourself.
Right.
What fits for one deal doesn't fit for everything. So ideally you can find where somebody's actually used it before, and then look at it and make sure you're clear. What are the elements? It's much easier to take a longer list and strike out 20, 40, 50% of the things than it is to start from scratch and figure out, I'm not capable of that. Most people aren't, of just inventing from scratch. So working with that. Obviously, you have to go through financial, you've got to go through customers, you've got to go through suppliers, you've got to go through any legal, all those different elements, and look at that. Also, you want to make sure you go through what you were talking about is the fit of the organizations, and have due diligence related to that. And in EOS, we have a specific process about fit. It's not about mergers and acquisitions per se, that's not a major part, but there is an element, and it's not all the financial customers, vendors, but it is about that fit on a couple of elements. One is cultural, and that often gets overlooked. Another is about the systems, and that's what you mentioned earlier. Every organization has at least one system, and I would strongly encourage one is much better than two, but many organizations honestly have 3, 4, 5, 6, 7 systems that they're running on. They just don't know it. And so digging into that and really understanding how that works, that makes a huge difference, particularly for a strategic buyer. If you got a financial buyer that's just going to buy it and let it run and just keep collecting from that in some ways you just say keep going. But if it's a strategic buyer, that's where you can have both that cultural and that systemic clash that starts to come into play day one.
Have you seen that either alignment or clash impact the amount of cash that you were willing to pay for a company?
Absolutely. I think it impacts everyone, and knowing, because it really comes down to there's an additional investment to be made to be able to bring those two together. So if you don't take that into account, maybe that's going to cause some retrenching during the initial months or even years. And keep in mind, when the really big companies do this, many times that acquisition or that merger doesn't work nearly as well as it did on the spreadsheet. And so you have to put in there is going to be additional investment made. Maybe somebody here listening has gotten really lucky, or they're just really smart and it doesn't happen. Typically, most of us tend to think we're smarter than we actually are, and we can do it easier than we actually can without including that additional investment that's going to be required.
So how do you actually assess if systems and culture are compatible? Because I can have a cultural maybe a lot of entrepreneurs don't have a clearly defined, this is our culture, but for the ones that do, having that on paper and then with respect, what actually happens, sometimes there's a mismatch there. So how do you get down to the truth of testing what is your company culture, what are your systems, and finding that?
Well, I think it helps a whole lot if one of the entities actually has a clearly defined on paper system. That is hugely helpful, because then you actually have something you can start saying yes alignment or no not alignment. And if both of them have it, even better. Now you still, for what you said, you still have to really test it, because just because it says it on a piece of paper doesn't mean that both parties are hearing the same thing. And that's where you want to walk through really some time together of talking through, what does this mean? What does this look like? Let's talk about practical experiences with that.
Because, and I think that's kind of a fuzzy part of the transaction that we really haven't explored in this series up till now, because the systems of what your accounts payable or your accounts receivables are. Well, that strategic buyer, by definition, is going to have a system probably have a system already in place, especially if they're, a much larger buyer, that's backed by venture capital or private equity or something like that. They're going to have their accounts payable people coming in there. So saying, here's my system for invoicing and receiving cash. That's more of I want to make sure you're current. Even with some of the other operational things, they might have their way of doing things. It's that softer, okay, how do we deal with human relations? How do we deal with the most valuable asset that's not on your balance sheet, your employees, to be able to say, okay, they're going to come in a line. And let me maybe ask this a different way. Have you seen deals, or have you been part of deals where you've done that analysis and then for maybe financial reasons, but maybe not financial reasons, you backed away and said, this is not a good fit for us?
I'm thinking specifically. In general, I would say absolutely, because I can think of a couple of situations where just the interaction at the leadership team level made it clear that we did not have an aligned mindset. I remember we walked away from a discussion, and there was this what seemed to us an over focus on everything driven by tax. And it's important, but it didn't seem to be an alignment of how to eliminate tax. And absolutely an important area, but just that conversation.
If that's the number one goal, then, and for a seller, well, that's a pretty big motivating. I completely understand that.
Yeah.
But it's got to be aligned in all facets, or at least, it's symbiotic to that. So how long, you said you've seen the due diligence process take a long time. What's the shortest amount of time that you've seen, and what's the longest?
I think the shortest has been, I want to say 8 weeks.
Wow, that's like light years.
It was, but the only way that happened is there was an outside force that if this didn't happen, the opportunity for both sides went away. And so that's what really drove that 8 weeks.
So that's an exception. Very
yes.
much.
And then the longest, it was about 2 years. One that was actually consummated, about 2 years. And that's where there was no outside force. Both parties did not have to do it. It gave that time to have plenty of back and forth to say, okay, this doesn't quite work. And one thing that was really helpful in the process is to keep going back to the question, what is each party's interest? And how do we listen to that interest from one another? And then how do we address it? And it actually gave the opportunity to be very creative in how we address those. Because if we had just gone head on and trying to drive through it, would have never happened. So that's kind of the two extremes, 2 months to 2 years.
So 2 years is a long time. I'm curious, did the interests and what they wanted out of it on both the buyer and the seller, did it change throughout that 2 years, or was it pretty consistent?
I'd say overall it was consistent, but definitely things changed. I mean, definitely it was the sense of, hey, we can have something better than what we have without doing a deal. And so that changed the interest a little bit of it in and of itself. Also, just life changes, and so there were some opportunities, and it could have gone the other way. And that deal died several times.
Yeah. So one of the things that we've heard from some of our buyers that this is such a unique situation to be in, because you're kind of like you start out dating, and it's like, yeah, you're attractive. I think that we'd like to get to know each other a little bit more, and then you fight, and then you get married. So, and one of the things is that, and I completely understand that through that process, the seller wants to have their objectives. It's not only monetary, but monetary. They want to keep that monetary value up as high as they can, or at least up to where they have to. If it goes below a certain value, then it doesn't make sense for them. But the buyer's like, well, if I could knock 20% off of it, actually, as I'm going in the due diligence, then that's going to improve the return that the buyer has. So it's kind of like, I've heard it said that once you actually get into it, and during that fighting time, the buyer's trying to find any way to lower the price, the seller's trying to keep it up. From the buyer's perspective, one, do you think that that's accurate? And then two, it can't be malicious, because if it's malicious, then there's obviously a misalignment, and that the deal's going to go away. But how do you work through that? Because that's a whole lot of friction.
Yeah, it is, and I don't want to be idealistic about this. I'd like to think I'm not just totally driven by either making the sell price as high as I can get it, or making the buy price as low as I can get it. But I also recognize that's just kind of in us to, watch out for our own interest. So the key in there is, one, to be honest and clear about what those interests are. I think that makes a huge difference, and being able to talk about that openly. I'll use your example of marriage, something important in my life, but I remember a couple who was getting married, and say, we've been reading books and we don't really see we're going to have these marriage challenges before they got married.
Just wait.
I love the laughter there. That's exactly it. And now looking back, they kind of laugh, and they remember saying, we're not going to go through all those things. But the reality is, I think while we as married folks, we can kind of laugh at that. You and I are both being married. But a lot of times the deals are approached as if we're not going to have that, and that undercuts, and it creates so much unfulfilled expectations in the process, and frustrations and disappointments, as opposed to one thing that I really like doing is saying, let's just assume I just go off a deep end, and I really go into just being a lunatic. What could happen? And then flip that. What happens if other people just become a lunatic? And that way, when it happens, it's just not such a difficult thing to, and not that anybody actually necessarily goes off that deep end, but there are things that
Well,
go
I mean,
sideways.
in all of the purchases and buying of businesses, that has had to happen. But I think that what I heard was kind of like what you went back to during that 2-year deal. It was an open and honest communication of the expectations and what the wants are for each party. And even if you were trying to beat each other up on valuation or structure or whatever it is, you are both aligned to say, I hear what you want, and I can support that, and can, because at the end of the day, it's got to be attractive for both parties, otherwise it doesn't get done.
Right.
So talk to me a little bit about the structure in some of the deals that you've done. I know that every deal is a little bit different, but in your experience from a strategic buyer, was it a all cash transaction? Was it a partial acquisition where the owner maybe kept some equity, maybe they got equity in a new entity? Is there any type of seller financing?
All of the above. I'm trying to remember if there's any that I've been involved with where it was all cash up front. I can't think of any on either side of that. At a minimum, there was a holdback.
Okay.
It was usually, the shortest holdback I remember was one that was about, I want to say 9 months. And
that's relatively, so not even an entire calendar cycle or financial cycle.
Yeah, and that was mostly around the due diligence item, just to make sure there were no unexpected legal, financial things that were not uncovered in due diligence. So that's about the least. Most of the time, there's something in that 3 to 5 year, basically earnout.
Mm-hmm.
And earnouts, they create a huge opportunity for difficulty. So while I would strongly encourage simplifying the deal as much as possible.
Mm-hmm.
In fact, I had a recent discussion with someone who was looking at and just asking me to look over a deal and give some feedback. And my basic feedback was, if you can eliminate half of these complexities, you will be so much happier. And he came back to me later saying that was great. They simplified it down, and then 2 weeks after they said, and now the deal's off. So it really helped them to avoid some long-term pain and distress.
Because what I've heard earnouts to be very, very good and profitable because the current entrepreneur stays on, it still has meaning and purpose, and is able to grow and not worry about how payroll's going to get made, and to benefit from that. But I've also heard that, okay, now you're part of a larger system, and you have to remember that it's not most of the time it's not your business anymore. It's going to be run the way that the buyer wants it to be run, and sometimes that's tough to be able to say, well, this is the wrong way of doing it. This is the wrong approach, and that's preventing me from earning my 10% holdback or whatever it is. So having that conversation and being very honest with, okay, what is the good and what is the bad, and work through this. What about non-competes? Have y'all dealt with those, and did you insist on them, and why?
Absolutely. So the non-compete, it gives some level of assurance for the buyer that they're not going to be going into competition with themselves effectively by the seller going out and starting something new. So they're very valuable. At the same time, they can be challenging to enforce. I'm not an attorney, but I think they can be challenging to enforce, and I think it is something of setting expectations with one another. Not that they don't have teeth, and not that they shouldn't be respected. They absolutely should. I think it's important for each party to just make clear it's more about that expectations on the front end. That's my experience. And I don't see, my experience is that I haven't seen a lot of people challenging it. I know there are examples out there, but I think most of the time people have those non-competes, and they generally abide pretty close to them. So it's worth putting in there for that.
So as You mentioned talking about, that holdback of 9 months, and it was to make sure that the due diligence analysis was correct. How did you deal with situations where there was a potential liability, both, financial, environmental, operational? Because every business has risk, and so you can't say, I want a clean slate, no liability at all. I mean, I guess you can in an asset purchase. But how did you deal with that as a buyer, knowing that there's going to be some skeletons in the closet?
Yeah, well, typically, and this is getting again into the legal area, so I want to respect the attorneys, the expertise, but typically that asset purchase helps a lot. So not buying the liabilities and of course indemnifications in there as well are the ways those get addressed. I think that's kind of a default from a buyer standpoint of that this is going to be an asset purchase. We don't want to buy all of the skeletons and all the baggage that comes along with this.
In your experience, what is the toughest part about the buying process?
I think one of the most challenging is getting clear on what each party wants. I think if you once you get that, it becomes so much easier to define, can we have a deal or not? And then when you run into those roadblocks, then you can start putting on creatively. What I found multiple times in the negotiations is we'd run into a roadblock only to realize we're talking about apples and oranges, or we're talking about elephants and apples maybe.
Yep.
And if we can be clear, they really care about elephants, we really care about apples, then there's usually a great way to solve it. If we both are caring about the apple and we just want to get the biggest part of the apple, I'd say that's more rare than what people think it is. Then if that's what it is, now it's just who can tug of war. But if I know what you want, then there's often ways to structure the deal fairly simply to make sure you get what you want and I get what I want.
But that's really difficult from an entrepreneur that maybe this is the first time selling their business. I mean, they've worked at it for 10, 15, 20, 30 years, and this is the one time that they're going to sell the business. So having a clear knowledge of what you, the entrepreneur, wants to achieve, not only from a dollar amount, but the structure, and then how important having that cultural alignment. Are you an entrepreneur that looks to just cash out, or are you an entrepreneur that wants to have the legacy of what you built continue on? And being super clear and honest about that is really, really tough.
Yeah, I just on the seller side, kind of flipping sides, a buyer decided they really didn't want this customer that we had a great relationship with years. Now this is after the deal was done, and that was really tough for me. But I had to recognize, as much as I valued that relationship, that I had not seen that on the front end as a priority. And so just understanding that sometimes that will happen. And I can't say that the buyer in that case was wrong for that. It's not what I would have done, but it's not what they saw as being the priority.
So from the buyer's perspective, timing is always kind of a tricky thing. So when in your experience did the sellers and the buyers kind of come together and tell the staff, tell their suppliers, tell their customers, hey, guess what? We just made a deal. You don't want to do it too early in case it dies 8 times.
Right.
And you don't want to, have necessarily close and be like, oh yeah, by the way, he's been your boss for a week.
Yeah, that's a tough. I'd say the default that most people go to is wait till everything is signed and the next day come in and make an announcement, and there's kind of shock on everybody's face and some dismay for some people and not a lot of anxiety, and that's kind of the default. But I have also participated in communicating very openly on the front end. Now the risk there is if you communicate openly on the front end, And especially if you do this multiple times, that's where it can feel like a roller coaster for the team. And that has some real risks that it can cause you to lose people, cause unnecessary anxiety, those kind of things. So that's the balance. At the same time, what I like to say is, we're building this business to run it forever.
Mm-hmm.
And we want to run it as profitably as possible. And at the same time, be very upfront with the entire team that if somebody comes along and is willing to write a check that we consider to be outlandish, then yes, that is also an opportunity that we will look at. And it starts to create this honest environment about what's out there. So it's going to be different for every person. I would hate to prescribe something because I think this is so personality driven of that individual, but there are those extremes. I don't know if I've ever seen it go much beyond a week after the deal being closed, but that's something that is definitely worth talking about and thinking and being clear about.
That's right. Because that's, again, those are, you've got the business, but then you've got the relationships. And it's those relationships that has made that business family, especially the longer that you're part of. So let's kind of shift gears here for the next 5 minutes or so, and let's talk about how EOS really is impactful in a mergers and acquisitions type situation. Obviously, we talk about having that system and that structure in place and be able to very clearly define the roles and the responsibilities and the communication rhythm and everything like that, and that can be very attractive to a buyer. But I know that you've also told me that while it's not necessarily part of the heart of the EOS system, but there are actually mergers and acquisition discussions.
Yeah, and there's actually a tool to facilitate the merger and acquisition discussion in EOS. So it's in there. I think the big thing that you're hitting on is without a system, whether it's EOS or anything else, if without a system, that business can be very dependent on 1, 2, 3 people, usually the founder. And sometimes it's hard as a founder to see how integral they are to that business, but that is a huge deduction in the value for most buyers. For one, there's obviously what happens if the founder meets that proverbial bus, but there's also the element of how things change when it happens. However, if the business is operating and can operate independently of that founder or that owner, that means the buyer has so much more security that this machine is going to keep right on rolling, even if we lose the owner, founder, one or two key people in the organization. So that's going to increase the value. Also, there is this financial element that often owners are underpaid and they get the bonus. And so I sat down not that long ago with somebody and they said they were making, I'm just making up numbers, but that they were making $200,000 a year in the business, but the reality is they weren't taking a salary. And so I said, well, how much would it cost to replace you? And that number was, and again, I'm totally making up numbers here, that number was $160,000. And in that case, it went from a $200,000 a year profitable business to a $40,000 a year. Totally changed what the valuation would be in there. And that's the financial example of it. But that also occurs on just the way the systems operate and being able to operate independently of 1 or 2 individuals, as opposed to driven by a leadership team and a system that's going to keep going long after.
So last question, as the entrepreneurs are looking to potentially exit their business, what's one bit of advice that you would give them to prepare them for the roller coaster that is selling your business?
Oh, one thing, that's tough.
Narrow it down.
I would say focus on loving running your business, because if you do that, then you're not going to be in a position where you become desperate to sell, and you're not going to be stuck, going back to what we said earlier, in this very difficult situation where somebody has the power of your future in their hand if they don't agree to this.
Yeah.
Because that's critical. The other part of that, though, is if you're focused on building that business and the value, regardless of whether or not you sell, you're making yourself more valuable. And in that, think about your role. And this is a beautiful double benefit. You're both making yourself more valuable as a business, but you're also, even if you don't sell, you're making the business more independent of you, so you can take more vacations. You can step out, you can sleep better at night, all of those different things. So that would be the biggest set of advice.
That's right. Well, Randy, thank you so much for joining us and sharing your wisdom and being very open and transparent as always. So really appreciate that. I know that the audience is going to get a lot of value. Just want to make sure that it's clear. We said it for all of our other episodes, but Randy's opinions and my opinions are our own. They don't necessarily reflect our employer or any affiliates or anything like that, but really appreciate the wisdom. How can an entrepreneur, if they want to talk a little bit more or pick your brain or get some background from you, how can they connect with you?
Well, the easiest way is a phone call, 979-574-4571. Feel free to call me anytime, or reach out and email me at randy.mcdougal@eosworldwide.com. Would love to visit, talk, help out any way I can.
Awesome. Well, thank you all so much for joining us today, and we look forward to seeing you on the next episode. Until then, this is Greg Martin, the Entrepreneur's Banker. Thank you so much for spending time with us. Well, as always, Randy just brings it. I just learned so much, and I know that you did, from Randy's conversation. The top 3 things that I really took away were, 1, you need to understand what each side is looking for. And you need to communicate that throughout the process, because by understanding what the other side is looking to achieve allows you to have open and honest conversations. And maybe you tweak the deal or you structure the deal differently as it kind of goes throughout the entire due diligence phase. 2, talking about due diligence, having a due diligence checklist. I loved his hack of just saying, look, a lot of entrepreneurs haven't done this before, so just Google a due diligence list and you'll probably come up with something that's a really long laundry list of things that have to be included in your due diligence packet. And it's easier to go and just cross off the items that don't apply to you compared to having to come up with ideas of your own. And then 3, and this should come as no surprise given his background as an EOS implementer, but systems are critical. And we've heard that over and over again, not only from sellers, but from buyers, that an entrepreneur who is selling the company wants to get the highest value, wants to get the highest price. A buyer wants to make sure that cash flow that they're buying, that net income is going to be consistent, and having a systems in place that makes the reliance on the owner or owners less important is super, super critical to keeping that value up high to where a lot of sellers need it to be. So having systems, all types of systems in place to have your business continue to run smoothly is so important. I hope that you enjoyed this episode learning from Randy. If you're not connected with him on LinkedIn or on Facebook, I really hope that you do take the time to give him a call. I mean, he had his phone number out there. Randy is such a wealth of knowledge, and he has such a pure heart to be able to want to help and push entrepreneurs towards success. You will not be disappointed if you bring Randy into your circle. I guarantee it. Well, I hope this episode brought immense value to you. And I hope that you join us next week when we talk with Peyton Holt of Holt & Hutchins Law Firm. Peyton is the entrepreneur's lawyer. And so it's just natural that I had to interview him for this series, because understanding and having an attorney as part of your deal team as you are looking to exit is so critical. Obviously, this is a complex and legal transaction, and having someone that's on your side that understands what your objectives are, understands the laws, and understands the potential risk that you might be exposing yourself throughout the sale process is super critical. Until then, this is Greg Martin, the Entrepreneur's Banker. Wishing you have an amazing week.